Hi rabbits, Research Turtle here. Today we are deep diving into a fascinating geopolitical shift that unfolded in January 2026. We're looking at a phenomenon called the reverse currency war and why the US Treasury Secretary Scott Bessent did something completely out of character. He intervened to strengthen the South Korean won. Let's start with the event itself. On January 14, 2026, Secretary Bessent publicly stated that the won's weakness was not in line with fundamentals and that excessive volatility was undesirable. Now, why is this weird? In the old world of trade wars, countries wanted weak currencies to export cheap goods, but we have entered a new world, an investment war. In this new era, a strong currency is necessary. Why? Because the US doesn't just want Korea's cars anymore, they want Korea's factories. Here is the context. Back in November 2025, the US and Korea signed a massive strategic deal. The US offered a carrot, a 15% tariff cap to protect Korean exporters. In exchange, Korea brought the stick, a commitment to invest a staggering $350 billion into the US. This includes $200 billion in cash installments and $150 billion for shipbuilding and infrastructure. But here's the trap. When the won collapses to 1,500 per dollar, the cost of that investment explodes. We're talking about 70 trillion won in added costs. Korean firms stopped investing because they were simply waiting for the currency to drop, creating a political vacuum for the US jobs agenda. This isn't just about money, it's about national security. Look at shipbuilding. The US capacity is at its nadir, while China controls 50% of the market. The US desperately needs that $150 billion in Korean capital to modernize yards like Philly Shipyard. Then there's AI. Samsung and SK Hynix are building HBM plants in Texas and Arizona. A weak won causes a second inflation in construction costs, stalling the very infrastructure the US needs to beat China in the AI war. So why can't Korea just fix it? The slide on Sayhawk ants explains the structural crisis. Korean retail investors are selling Samsung to buy Apple and Nvidia. This capital flight now dwarfs the trade surplus. Furthermore, the Bank of Korea is in handcuffs. If they raise rates to defend the currency, they trigger a household debt crisis. If they cut rates, they crash the currency further. Because the Korean central bank is paralyzed, the US Treasury had to step in. This brings us to the grand encirclement strategy. Bessent views Korea not just as a trade partner, but as a technological kill switch against China. If the won collapses, Korean tech prowess might drift back toward Chinese capital. Strengthening the won is about keeping Korea firmly integrated into the US industrial supply chain. Interestingly, while the US worries about the Japanese yen for financial stability, carry trades, they worry about the Korean won for the real economy, jobs, and ships. Looking ahead, verbal intervention is just a temporary fix. The slides predict that to make this $350 billion investment actually happen, we might see investment purpose currency swaps, where the Fed lends dollars directly for construction factories. To wrap up, the US redefined Korea. It is no longer a small country whose exchange rate is its own business. In 2026, the value of the won is not determined in Seoul, but by construction schedules in Texas and shipyards in Philadelphia. That's it for today. Turtle out.